5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Alrighty, friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. My name is Jerry Robinson, economist and trading coach here at followthemoney.com. You know, it has really been a wild few weeks in the markets. You know, gold recently just had its biggest single-day sell-off since 2013. We have the U.S. dollar trying to perk up a little bit from where it's been down in the doldrums this year. Apple just broke out to a new record high on the back of massive iPhone 17 demand. Also, the number of leveraged ETFs has exploded to record levels lately. We're going to talk about that a bit. Also, Bitcoin and Ethereum both attempting to rebound after a pullback sent them down to recent lows. So in this episode, we're going to step back. We're going to take a look at the big picture and talk about what it really means to ride the trend. Of course, here we are trend traders. We like to follow the trend. We've developed our own trend trading software that we use to stay ahead of the markets and ride right along with the direction that the market is going. And we're going to talk about the recent gold correction. I'll share what's happening with the U.S. dollar, why the Apple breakout matters for the broader market. And then later in segment 2, we'll talk about the record growth in leveraged ETFs and why discipline, not leverage, is really the key to success. And before we close, I'll share a final word that is just as true for traders as it is for life itself. It'll be a nice encouraging note for you at the end. Also, a quick reminder for our members, our new position trading mastery course kicks off live this Tuesday, October the 28th, during our weekly Trends and Profits webcast. If you're not already a member, now is the perfect time to join and get access to that brand new course. It's going to be a 10-module course. You'll also find my 3X ETF trading strategy masterclass available right now on our website, followthemoney.com/shop. That's a great way to learn how to use these powerful tools responsibly and profitably. And with all that said, let's jump right in. Well, let's begin with the big story of the week, and that is physical gold. After months of incredible gains and a historic run to fresh record highs, physical gold just suffered its biggest one-day drop in over a decade. You got to go back to 2013 to actually see this type of single-day sell-off in gold. The yellow metal fell over 5% in a single session yesterday. Spot prices plunged from a record above $43.80 down to around $4,100 an ounce. And if you're watching the miners, names like Barrick Gold and Newmont and Agnico Eagle, some of the top names out there, they all fell more than 8%. You look at the Van Eck Vector's gold miners ETF, GDX, for example, it got hammered nearly 10% on the day. Now, this is after what has really been the best year for gold in a half century, right? The metal is still up roughly 55, 56% or so year to date. And that's even after this correction that we just had. So it's far from being, broken down, technically speaking. In fact, when you look at the chart, gold has simply pulled back to retest its 14-day exponential moving average, right? So it hasn't even pulled back to its 50-day moving average after going parabolic in recent weeks. So in our view, this looks a lot less like a crash and much more like a reset, maybe a breather as opposed to a complete breakdown. And I've said it before and I'll say it again, no market goes straight up in a straight line, right? Not even gold in a strong uptrend. It needed to cool off. In fact, when you look at the monthly RSI on gold, it had gotten up to 93 as I've been telling our members now for weeks and weeks, we have never seen that before. We've never seen it get above this level, going back for decades, right? So gold had really done something unique. The technical strength here was just simply off the charts. And, now, as we are looking at what's happening, we see that, well, gold needed to cool off. I mean, the selling was fast and dramatic, yes, but my trend system still says that gold is firmly in a long-term uptrend. So what this kind of move does is it tends to shake out the weak hands. It tends to shake out the late buyers and reminds everybody that, volatility is going to cut, both ways. Now, somebody might be thinking, what in the world triggered this sell-off in gold? Well, there were, a few things. The dollar began to strengthen this week, making gold more expensive for foreign buyers. So that's certainly there. There's also a bit of profit taking after the festival season demand in India tapered off. That was another, minor, probably a more minor incident, but nonetheless, that also helped bring the price down. And then, of course, optimism around a potential new trade deal between the U.S. and China, with both leaders, by the way, expected to meet next week, also reduced some of that safe haven demand that we have been seeing. And as I mentioned, the technicals were screaming to us that it was time for gold to, back off and consolidate a little bit, take a breather. We had just been going parabolic. I mean, week after week after week, it was really getting a little bit concerning. Nobody really wants to see that kind of price action in their currency. This is why I'm saying don't miss the forest for the trees here, because gold has been climbing for structural reasons, right? Reasons that have not changed one bit since the sell-off happened yesterday. I mean, global central banks are still accumulating. They're accumulating at, record levels. You have governments that are still debasing their currencies, right, including the United States on a regular basis. Geopolitical and economic uncertainty still remains high, right? And what's interesting is that we're also seeing some analysts calling this the start of a potential great rotation from gold into Bitcoin. Some are suggesting that Bitcoin, historically lags gold's move by, around 100 days. And that is technically true when you go back on the charts and you look at it. So we could be nearing that inflection point. Maybe. Time will tell. We'll see if the outflows from gold actually really benefit Bitcoin. We'll see. But my view is simple here. This is not in any way, shape, or form the obituary for gold's uptrend in my view. I mean, everything that I'm looking at suggests that gold is simply taking a breather. I mean, you can't have a 50% year-to-date gain without expecting some volatility. So for me, I still remain bullish on the metals longer term, especially into next year. Silver and platinum have also seen big pullbacks over the last day or so, and they too were overdue for some consolidation, not as much as gold. They were pretty overheated, but not nearly as overheated as gold had been. So, it's not surprising to see this pullback. Now, the trend is still up in all three of these metals, but we needed a reset. And I think that's what we got. So this is where, disciplined investors, smart trend traders are separating themselves from the emotional ones, right? Don't chase when things are euphoric, and don't panic when it corrects. We just simply follow the trend here at followthemoney.com. That's what we teach our members to do, and it's worked out fantastically over many, many years. Now, in addition to what's going on with the price of gold and silver, we also want to talk about the U.S. dollar, right? Because the U.S. dollar has also been making some moves as of late, often called king dollar, by the way. And if you look at the U.S. dollar on a chart, you can see that it's really been hammered over the last, ever since the beginning of the year, ever since the inauguration. The value of the dollar index has fallen from around 110 at the beginning of this year. It got as low at one point in late September. It got down to around 90, I want to say it was like 96 or so, 96.50 or somewhere around there, maybe 96.25. Well, that's brutal when you think about it falling from 110 to 96, I mean, that is the US dollar. I mean, that's a currency. That's not some tech stock that got overbought or something and is getting hammered. This is a currency. So when currencies move like that, that's a really big deal. Now, we've been consolidating in the dollar since about May. We've just been grinding sideways. We have touched that fresh low in September, but we're also kind of bobbing back and forth between that 96 level and then up to, say, around 99 or so. And right now, the dollar is just kind of hovering around a flat 50-day moving average. And the longer-term trend has been weakening ever since the breakdown below that 200-day moving average earlier this year. It was back in late February, early March, when we lost that key level of support. So from a technical standpoint, the dollar is still a market in decline, and our trend system continues to read the dollar as being in a long-term downtrend. I don't suspect that's going to change anytime soon. Again, what's the catalyst for the dollar to go up here? I mean, I can't think of anything short of a black swan event that would drive a whole bunch of people into the dollar all of a sudden. So I think really what's going on here, and I think it's pretty obvious, is that this is not simply a chart pattern issue here. This is a credibility issue for the United States. The dollar's global dominance depends on trust, right? Trust in U.S. institutions, trust in central bank independence, trust in the Federal Reserve, trust in the Treasury, trust in the president, right? It's the idea that America will keep its word. And if that becomes questioned, then you're going to have problems. And that's what we've been seeing as of late. There was a piece in Foreign Affairs recently that former Fed Vice Chair Lael Brainerd wrote about the dollar's dominance and basically said it's just being tested like never before. Her piece was entitled Exorbitant Pillage, kind of a play on words from the exorbitant privilege that we enjoy with the United States as the global reserve currency. Anyway, her article warned that the real threat to the dollar isn't China, it's not the BRICS, it's not digital currencies, it's Washington, D.C., right? It's the U.S. government itself. I mean, for decades, America's institutions like the Federal Reserve and the Treasury and all of our data agencies, they were seen as the gold standard. But now, we've been seeing it slowly but surely change. Those perceptions are changing. The Trump administration's efforts to pressure the Fed into deeper rate cuts, to fire independent officials, and to just unilaterally impose tariffs on both allies and rivals has begun to further erode that institutional confidence that we have so long enjoyed. Remember, you can't forget this now, the U.S. dollar's strength is built upon faith, right? It's really a faith-based currency when you think of it. It's not just faith in our economy, but faith in our ability to restrain ourselves from giving into our more baser instincts, restraining ourselves from printing the currency into oblivion, restraint from, issuing too much debt that would weigh on our currency. And when that faith weakens in the dollar, when it weakens in our ability to, restrain ourselves, the currency pays the price, right? And so the rest of the world isn't standing still. You got China, you got Russia, you got Brazil, you got India, others who are building out alternative payment systems that bypass the dollar altogether. Right now, let's be honest though, there's really no single challenger that's ready to replace the greenback, right? You have a coalition of alternatives that have been presented that could gradually chip away at U.S. dollar dominance. And we would say that's already happening. But, the dollar's share of global reserves has fallen from 71% back in 1999 to about 58% today. That's a pretty steady decline. And when you combine the ballooning U.S. debt, which, by the way, the U.S. debt clock now showing that we are closing in very quickly now on $38 trillion on the national debt. I mean, that's simply outrageous when you think about it. So expect that headline to be showing up pretty soon, $38 trillion national debt. Hopefully they'll report on it. Maybe they won't. I'm talking about the financial media. They've really kind of avoided much of the hard news out there that we really need to be focused upon, like the national debt, which won't stop growing, the deficit spending that's out of control. But when you combine the ballooning U.S. debt with the political dysfunction that's coming out of Washington, it's outrageous. And then you have obviously these open attacks on the Fed's independence coming directly from the White House. That's just not a good formula for long-term stability for your currency. And I don't really think that we're really long for, long-term stability here in the United States, given where we're heading. So it's really just a matter of time, right? Now, from a trading perspective, however, I'm watching that flat 50-day moving average on the US dollar. I'm looking at that swiftly declining 200-day moving average. We're seeing a clear series of lower highs and lower lows. So we're clearly in a downtrend here in the US dollar. So we have a bearish setup. But big picture, the dollar still benefits from inertia. The world just keeps using it because it's convenient, it's liquid, and it's the currency of choice still today. So we're not talking about any kind of overnight collapse. That's not what I see at all. I've never talked about that. I've always said that it would be a gradual, decline in the U.S. dollar. And that's exactly what we've seen, quite frankly, right? We're talking about a slow erosion of privilege. You could say that King Dollar is sitting on the throne, but the crown is slipping. We could put it that way, right? I mean, it was definitely still on the throne. Definitely the dollar is still king, but for how long, right? How long is that going to last? Well, we're certainly losing that crown slowly but surely. And of course, that has big implications for everybody who is holding dollar-based assets, because as the dollar weakens, then real assets like gold and silver, commodities, Bitcoin, even equities tend to strengthen. And so while this week's gold sell-off was dramatic, it wasn't happening in some sort of vacuum. It's part of a much larger story where we have the slow grinding revaluation of what currency and trust mean in an evolving world that we're living in here. All right, let's shift gears from gold and the U.S. dollar to something a little different, and that's Apple. Apple just closed at a new record high after a huge week of news and also an impressive iPhone 17 launch. Shares jumped nearly 4% on Monday to finish at $262. That was basically a new record high, and it was driven mainly by stronger than expected demand both in the U.S. and China. That was encouraging to see Chinese demand picking back up for iPhones because it had fallen for some time. According to Counterpoint Research, the new iPhone 17 series outsold the iPhone 16 by 14% in its first 10 days on the market. Now, that's a really big jump for a company that many folks have, called mature or topped out, or they really can't get any bigger. The base iPhone 17 model is really proving to be a hit. You got a better chip, you got an improved display, you got more storage, you got the camera is much more robust, and it's all at the same price as last year's model. So when you combine that with the discounts and the carrier incentives and all that, it's a no-brainer purchase for many consumers out there. Loop Capital noticed that this strength was unusual, and they upgraded Apple from hold to buy. They raised their price target all the way up to $315 per share. Consider that Apple's still trading around $260 or so. So that's quite a nice rise over time. Up to $315 is the expectation from Loop Capital. Their analyst said they believe there's still upside through 2027 as Apple's ecosystem continues to expand. And I agree. And in the spirit of full disclosure, Apple is my second largest position in my long-term investment stock portfolio, behind NVIDIA. NVIDIA is my number one holding. And I've owned Apple for years. I continue to believe that betting against Apple is just a bad idea. It's one of the most disciplined, innovative, and well-run companies on the planet. People forget that Apple absolutely nailed the 2020 pandemic. It innovated through all that chaos. And when many tech companies were stumbling, Apple just kept right on executing. Sure, the stock has lagged a bit this year. It's up like 4 or 5% this year, year to date, compared to the big gains we've seen in names like NVIDIA, Meta, and Microsoft. But, it's up around 24% just over the last 3 months. So we're seeing some momentum there. And what we're seeing now is really kind of what I think is a rotation back into high quality names like Apple. With rates coming down and the Fed pivoting towards more easing, we have expectations of a rate cut this month. Later this month, we have one coming up expected in the month of December. And then there's another one expected in the month of January. So we're going to be seeing, falling rates. We're already seeing rates come down. Bond prices have been back on the rise this week. And investors are once again just rewarding these durable cash flow businesses that have really fortress-like balance sheets, and that's Apple, right? So Apple also, as I mentioned, they also continue to dominate in China, which is really remarkable given the geopolitical headwinds and all the tensions that we've seen between the U.S. and China. CEO Tim Cook was just there last week. He was meeting with Chinese officials, even attending the launch of Apple's new iPhone Air, which, by the way, sold out in minutes, according to the South China Morning Post. That's a good sign for Apple. So what's the takeaway here? Well, for me, Apple's breakout is just another reminder that innovation and consistency always win in the long run. See, markets get noisy and so the critics will come out, but quality companies just are going to keep executing. And I think Apple is just one of these high quality companies that you really shouldn't bet against. This new all-time high, in my opinion, could be the beginning of another leg higher. That's what I'm expecting, especially as we move into the holiday season and beyond. And if the next earnings report confirms this strength, then I think it's going to force a lot of underweight funds to buy back into the stock. In fact, I've been telling our members for some time that I do want to prune my Apple holding, but I've been waiting for it to get back to a fresh high and also just kind of get a little overbought. And I think we're starting to move in that direction. So I plan to sell into some of this strength over the next, especially if we continue rising, over the next couple of months and raise some cash, not to get rid of my Apple position, but just to trim it. You see, I like to sell into strength, right? And then to buy into weakness. That's the way that you grow your account over time. And so here we have Apple leading again. And as a trend follower, that's exactly what we want to see. We want to see that leadership emerging out of that consolidation pattern, breaking to new highs, and then pulling the market higher with it. That's what we expect. All right, so we're going to take a quick break. And on the other side of the break, I'm going to come back and talk about leveraged ETFs. We see there's like 700 of these things now. When I first started talking about them back in 2018, they were like, 100 of them. So these getting really, really popular. I want to talk about those and also talk about Bitcoin and Ethereum just briefly in segment 2. So we'll talk about all that when we come right back. We'll see you in a minute. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Welcome back to the program, friends. My name is Jerry Robinson. You're listening to the Follow the Money podcast, one of the longest running podcasts on the topic of personal finance anywhere on the planet. We've been coming to you since 2010. You can find us online at followthemoney.com. All right, so we talked about gold and silver and Apple in our segment number 1. Let's move into a couple of other topics. In this segment, I want to talk about leveraged ETFs, which are really popular, getting more popular by the day. If you've never heard of these, I'll just briefly explain what they are. And then I also want to talk about Bitcoin and Ether briefly toward the end of this segment. But let's begin by talking about these leveraged ETFs. When I first started teaching about these products years ago, because there's always been an interest in them, There were maybe 100 of them. I used to have a big list of all the different leveraged ETFs. It was simple to keep track of. Today, according to a new report by Bank of America Global Research, there are now more than 700 leveraged ETFs trading on U.S. exchanges. And that's really remarkable growth, and it tells us a few things. First of all, that investors are hungry for leverage, right? They want to be able to amplify their returns without using margin or futures. And quite frankly, I think out of the two, if you're going to trade leveraged ETFs or you're going to get a margin account, I think quite frankly, it's probably better to avoid the margin account. Most people I see blow up their accounts with margin, and I always advocate to newer traders, newer investors to just forego the margin account, even though it's offered to you, even though it's easy to get sometimes. If you qualify for it, it's tempting to use margin when you trade. And for those who don't know what that means, is basically you're borrowing money from your brokerage firm, and they'll often double up what if you have a $40,000 balance, they'll double it up, and give you $80,000. But then there's a thing called margin calls, right? Which you definitely don't want to get. If you've ever got a margin call, you know that it's not fun whatsoever. And what I tell people is just stay away from margin. It's usually just a bad idea. Well, when it comes to leverage ETFs, you're kind of getting that benefit in that, you can trade something like one of my favorite leveraged ETFs that I've traded over the years and I've told our members about many times is TQQQ and also SQQQ. So what is that? Well, QQQ is the NASDAQ 100 ETF, the Invesco NASDAQ 100 ETF. And so I like the NASDAQ 100. I invest in it. I also like to trade around my position. And so what I can do is I can use TQQQ, which is a really popular leveraged ETF, and it gives a 3x exposure. And that's exactly what you would think. 3x means that, you're going to get for every move in the underlying that is QQQ. Well, TQQQ is going to go up by 3 if QQQ goes up by 1. So if the NASDAQ 100 goes up by $1, then TQQQ is designed to go up by $3, right? So you think, well, that's pretty sweet. If you're able to, trade a trend and you can get that, get that leverage, well, that works out pretty well. So obviously these things are attractive for those who are looking for leverage, but they don't necessarily want to use margin or whatever. Now, the fact that we see all these ETFs that are leveraged, though, it's also a sign that retail traders are far more active and hopefully more sophisticated than they used to be. At least that's the hope, because these products are tools. They're very powerful, but they can be very dangerous in the wrong hands. I teach every single one of our students the importance of reading the prospectus before you ever put your money into any of these leveraged ETFs. And I also teach a lot of rules around them. And many people have done very well with these, right? They're very powerful. And in fact, they're no longer just leveraged ETFs on major indices like the NASDAQ 100. You can buy leveraged ETFs now on single stocks like Tesla or Meta or NVIDIA or whatever. So you can get more leverage for every penny it goes up. You're getting more leverage on it. So they're obviously attractive. But like I said, they can be very dangerous in the wrong hands. That's why I created the 3X ETF trading strategy course here at followthemoney.com. It's a 80-minute master class. We provide an ebook with it that walks through a simple rules-based system that I've personally used for years. And it demonstrates a way to trade leveraged ETFs intelligently with precision instead of relying upon emotion, which is what most new traders, do. And we teach you how to use data and how to use the trend and how to use discipline. And, I tell people all the time, leverage is like fire. It can warm your house or it can burn your house down, right? So you use it correctly, these funds can magnify opportunities. But if you use them recklessly, then they really magnify your mistakes. Now, of course, another reason why leveraged ETFs are booming right now is because traders see all this volatility, right? And they see opportunity there. The markets are rotating fast. You got gold selling off one day, you got Apple hitting a record high the next day, you got interest rates on the way down, which is going to cause even more upside potential for asset prices. And traders want to move with those trends in a nimble way. And 3X ETFs, these leveraged ETFs, just make it possible. But I'll say this, if you're going to trade these things, you really need to have a system. You got to have a plan. You've got to have entry rules, exit rules, position sizing rules. You've got to know your time horizon. Now, these are very short-term tools. They are not buy and forget kind of investments. So anyway, all of our members have access to that 3X ETF trading strategy course. I encourage you, if you're interested in that space, be sure to go watch that if you're a member. If you're not a member, you can just go to our online store and buy it. You can buy it outright. I think it's on sale right now. You can just go to our website, followthemoney.com/shop, and just find the 3X ETF trading strategy course. It's right there, that master class with the ebook and the video course. It's all right there. We teach a really cool strategy too that allows you to use a very simple system to make money with these things. So followthemoney.com/shop if you want to learn more about 3X ETFs and our rules and our strategy for making money from them. They're getting so popular. I wanted to bring it up here on today's broadcast. Now, let's talk some crypto here before we close out, because while the traditional markets have been chopping around, Bitcoin and Ethereum have really been, kind of stuck in this funk for a little bit, and they're starting to quietly rebound. After a week of heavy losses, we saw a pretty strong rebound early Monday. Bitcoin climbed up nearly 3% over the last 24 hours or so. It was trading briefly for around 111,000, 112, 113,000, but then it dipped back down. And as we are talking right now, Bitcoin's trading at about 108,000 as of this recording. So, and if Ether is also following suit, it got up above 4,000 briefly, but it's back down below that level now. That's kind of a psychological level for Ether. It's trading at about $3,800 or so. These are obviously the two largest digital assets, on the planet. Both of them are still off their all-time highs from earlier this year, even just earlier this month. But the structure of the trend remains intact. So what we see right now is we see that there is still a long-term uptrend in both of these cryptocurrencies, both of these digital assets, if you will. So I'm bullish as we head into the fourth quarter. Historically, Q4 has been Bitcoin's strongest quarter by far. Since 2015, Bitcoin has averaged a 20% gain in October. It's averaged a 59% gain across Q4. And going back to that, if you go back to that entire stretch from since 2015, Bitcoin has enjoyed an 82% compounded annual growth rate, during that time. And the fundamentals, quite frankly, are supporting crypto at the same time. I mean, you have the expectation of the Crypto Clarity Act that should be coming out of Congress once they get back into session. Hopefully, we're going to see that this year, which will really provide a lot of clarity for Wall Street to begin moving even more into this space. Governments continue to debase their currencies. Is that bullish for Bitcoin? Yes, right? Central banks keep accumulating gold. And as Deutsche Bank recently suggested, eventually they'll probably start accumulating Bitcoin too. Wouldn't that be quite a surprise to wake up one day and find out that, central banks are buying Bitcoin and gold, right? That would be pretty wild. Investors everywhere are still just trying to protect their purchasing power because we still have inflationary pressures that are, harming our economy. You have the rising geopolitical uncertainty, and that leads people on a search for hard assets, whether it's digital or physical. And I don't think that's going away anytime soon. So yes, Bitcoin and Ether still have some work to do to reclaim their highs, but the trend from our perspective remains bullish as we head into the remainder of Q4. And I believe that every pullback in a long-term uptrend is an opportunity for disciplined traders, disciplined investors. So just like we've seen in gold, these consolidations are a market's way of catching its breath before the next move higher. And in my view, that next move is coming in Bitcoin and Ether. So I would get ready for a strong rally into the end of the year. Time will tell. We'll be watching. All right, friends, as we wrap up today's episode, I want to leave you with a quote that really hits home, I think, both in life and in trading. It goes like this: one of the greatest awakenings comes when you realize that not everybody changes. Some people never change, and that's their journey. It's not yours to try to fix them. Isn't that a word of wisdom? And it really applies to the market too. The truth is, you can't fix the market. You can't convince it to go your way or to reward your timing or to respect your opinion. The market will do what it wants to do. And your job is to simply adapt, not control. Just like we can't control other people, we can't control the market either. And it's a hard lesson that we have to learn in life. Every trader eventually learns that lesson the hard way, right? You can't fight the trend. You can't rescue a bad trade, and you can't force people or markets to behave the way you think they should. The power comes in letting go of control and aligning yourself with reality. Really, that's really what trend trading is all about. We don't chase, we don't predict, we don't try to control those things that are out of our control. But instead, we observe and we respond and we follow the trend. So whether it's gold taking a breather or the dollar slowly losing its crown or Apple climbing to new heights or Bitcoin setting up for another run, the key is always the same. Stay humble, stay disciplined, ride the trend, remember what's in your control, and remember what is outside of your control. And that's just something to think about. Thanks for tuning in to this week's episode of the Follow the Money podcast. And don't forget, our position trading mastery course begins live on October 28th. All of our members, we encourage you to be there on our live Trends and Profits webcast. If you're not a member, go to followthemoney.com/join and choose your plan. Get on the fast track to learning how to trade, learning how to invest in a smart way. Also, if you're interested in that 3x ETF trading strategy masterclass, it's available right now at followthemoney.com/shop. Until next time, friends, this is Jerry Robinson reminding you, when you want the truth, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.